Okay, now we're going to get into day trading. For the purposes of this training, we call it popularity-based trading, and we'll talk more about some of the ways that you can leverage the daily happenings of the market. But before we jump into that, I want to talk to you about what happened with GameStop a few years ago, and the fact that it's easier than ever to impact the market as a retail trader. Now, first off, I just want to say that there's a wonderful docuseries that Netflix put together called Eat the Rich, the GameStop saga, and this goes into much greater detail about all of this. There are also other materials that are out there that you can read too, and you can go, of course, to Reddit and Wall Street Bets if you'd like to see everything for yourself. What we want you to learn from what happened is a concept called short interest and how that works. And short interest relates to short selling, which is a concept that we haven't covered yet. And personally, I'd rather not bet against someone, but that's just my preference. That said, I still want to explain what it is and make sure that you have an understanding of how to leverage short selling if you want to make that part of your strategy. As you buy assets, typically it's with the view that you're going to hold on to them for a while. With short selling, you're making a bet against the stock. Essentially, you're saying that the company is overvalued and that its price needs to go down. Or you might believe that the market is going to go down and that it's a good time to bet against the market. Now, just as a point of awareness, over a 10-year period, the market tends to produce a positive average return, so betting against the market doesn't usually work out. But over a short time period, it can, and it does for some investors who know what to watch for. Short selling is a more common strategy at hedge funds than it is with individual investors. And a lot of times investors will identify a company whose stock price has continually fallen. And after examining the company a little closer, if they agree that the company is likely to fail or to continue to lose share price, they'll take a short position, which is a bet that the price will go down. Now, they're able to make that bet by shorting shares of someone in a long position. And when the stock price falls, the losses of the person in the long position go to the person in the short position. This can work out well as long as the price keeps falling, and in the case of GameStop, their price fell pretty steadily for several years, and a few large funds had started taking short positions against them. When they viewed GameStop, they saw it as just another brick and mortar being overtaken by technology, and as games transitioned to online play and users can just unlock and download their games, there's no more need for a physical store to go to. Now, you might disagree with me based on the used market, but as far as new games go, it's all digital content anymore. And a long time ago, I was actually a GameStop employee. I loved that place, and it was an exciting place to be, but everything has its time, and really that was their bet. They just felt it wasn't going to exist much longer, so why not bet against it and earn a little bit on the back end? The thing that you need to understand about going short is that when you go long in a company, the most you can lose is your investment. So if you put $100 into a stock, the most you can lose is $100. When it comes to going short, the problem is the amount that you can lose doesn't have an endpoint. It can continue to grow, and at a certain point, you have to accept that you made a bad investment and cash out of your position. So using that same $100 example, if you take a short position and the stock instead goes to $200, now you owe the $100 difference when you cash out. And that $100 difference is called short interest. Now, that example might be pretty simple, and it might not sound so bad at $100, but when the stock is trading at $5 a share and you're in a short position, and then new investors jump in and suddenly it's trading at $105 a share, well, if you took a short position on 1,000 shares, where the long position in theory would have cost you $5,000, now you're looking at a loss of $100 a share over 1,000 shares, which is a loss of $100,000. So that's what we're trying to help you understand with short interest and how it works. Hopefully that also helps you understand why it's not a strategy that we recommend for new investors. What got some hedge funds in trouble with their shorts at GameStop is that the share price disparity and the quantity of shares that they had shorted were significantly larger than that example. And as a result, their short interest position built up to a level where it could bankrupt their fund and force their clients to lose all their investment. Now, like I said a moment ago, I worked for GameStop. Now, that was back in 2006, and I was in college at the time. I loved working at GameStop, and you always had such a diverse group of customers, and you never really knew what sort of questions you were going to get asked next. A lot of those questions were about older systems, so you can probably understand that some of the other associates and I would talk about starting our own stores and capitalizing on that market that GameStop didn't serve anymore. Now, what I'm getting at is that there's a certain nostalgia when it comes to video games and people's positive memories that they have associated with playing them. So to me, I think those positive memories had a lot to do with how all of this happened. And for the folks that took a long position, their opinion was and still is that GameStop is a good investment. To be clear, the hedge fund's large short position existed for several years before it generated interest by the online community and Reddit, and more specifically a group called Wall Street Bets. They started to look more into why someone would take that position, and what they found was, in their opinion, a heavily undervalued company and an opportunity to earn a return off the backs of the hedge funds. So as a result of their posts and discussions, it brought on a lot of interest to the stock, and then the stock price started to rise. It caught the attention of angel investors, and then suddenly large amounts of capital began flowing into long positions for GameStop stock. And as the price took off, retail investors were noticing, and they wanted to jump in on the action too. And when, demand increases for a stock, the price will continue to go up. Now, this didn't build up overnight. There was a lot of momentum that built up over time here. But what ended up happening is that the short interest grew to a point where it was going to bankrupt the funds. So what then happened was even crazier, because on the day that the price started to really spike and go up, in order to avoid a total collapse of these funds, the market makers behind Robinhood actually paused trading. It worked in the short term in terms of stopping the price increase, and on that day the price did fall back down. But there were a lot of questions for why market makers were allowed to do this, and they even came back and took on lawsuits at the individuals who took the long positions in GameStop. In fact, those folks that took those long positions, they had to go to court and they had to defend why they took those positions. And ultimately, you could view this from a few different perspectives. One, Wall Street made a bad bet, and the funds should have failed. Two, the Redditors, in your opinion, did it intentionally to ruin the funds, and they almost pulled it off. Or three, you can understand that this was just a moment in investing history where differing opinions caused an unexpected event. The point that I'm getting at by introducing you to the GameStop story is somewhat of a cautionary tale. Anyone can lose, but historically the retail trader was never well funded enough to make an impact in the stock price. Today, with social media, working together as a community is easier than ever, and the power of the people's will, it can become the way. It's also a reminder that the big and powerful are the big and powerful. And if you try to take them down, they will find a way to outsmart you and to continue to win. But don't let that discourage you. With movements like Occupy Wall Street and through events like this, hopefully you can see the power of stock ownership and the effectiveness of working together as a community on a common goal. So hopefully you're enjoying this content and you're finding it useful. My goal with this program has always been to help you understand a little more of what the academics teach finance students, so that way you can leverage those things for yourself. What most academics do not teach is day trading, and it's not really something that we recommend to you. Like if you're an individual with a job at a corporation and you think you're going to listen to a couple of podcasts and start doing some day trading while at work, you need to understand and recognize that your job is going to take up a lot of your time, at least if you're good at it. And things are going to pop up unexpectedly throughout your day, and your focus will be elsewhere. So you're going to miss out on those opportunities that you're looking for from a day trading standpoint. To me, day trading is something that if you want to do it, you need to be fully dedicated. It has to be everything that you're doing throughout the day. If it is, then yes, I'd agree that it can likely work for you. But in general, and for the vast majority of people that are listening to this, you have other responsibilities throughout the day, and I'm sorry, but if you think you're suddenly going to pick up day trading and make a bunch of money, the likelihood of that actually happening is pretty low. Now, that said, I still know almost all of you are going to try it. The idea, that someone could make an investment and suddenly become wealthy is very appealing. And with all of the media out there today, there are people out there that have had success, and people are drawn to them because they want to find out how to mimic that. Now, what a lot of those people do or preach is to trade off of the peaks and the valleys throughout the day. Now, there's this expectation that throughout the day there are going to be moments with lows and moments with highs. And if you jump in and out at the right time, you can make your earnings that way. And a lot of people that do this will also specialize in a certain area or in a certain stock. And it has more to do with how well they know that market or that stock. That also becomes a major factor as to why that person knows when to jump in or jump out. And from the outside, they make it look easy, but the reality is most people don't make as much money off of day trading that they otherwise would by investing in an index fund. And of course, our recommendation is to learn how to build a portfolio that acts like an index fund. So hopefully by seeing that difference, it helps you understand why we shy away from recommending this path. Now, that said, if you want to do this, you'll want to study a particular stock or a particular industry and figure out what makes that stock price go up and down. And when do the reactions come from the market, and what's going on in the market when it is going up or down. Even more so, you want to attend earnings calls to understand what's going on with the companies and what they are saying in response to events in the market and to questions about their company and their stock's performance. By doing things like that, you'll have a better understanding of why prices are moving the way that they are, and that will lead you to the performance indicators that you need to watch in order to understand how to make your predictions and ultimately your daily bets. Keep in mind, this path requires a lot of time and concentration. There's also a high transactional cost, so if you're making a lot of trades throughout the year, keep in mind the taxes that you'll have to pay on your gains, and if your brokerage firm still charges you for the trades, find another one. There are a lot of great trading platforms out there that will allow you to trade for free. So if you're someone that wants to do this, certainly it's a path that you can take. We just recommend that you find some mentors, some folks that already do this and are successful that you can learn from. And whether that's an individual investor from your community or somebody online that you follow, you always want to be willing to learn and to find others to learn from. It will only help you, and you might end up building a whole new community around you in the process. I once went on a wine tour, and I'll never forget this. Somebody asked the winemaker what makes the best kind of wine. And he responded that the best kind of wine is the wine that tastes best to you. And that's always stuck with me. If you're going to be successful doing this, find something that's special to you and concentrate and spend your time researching that. If it's already an interest of yours and something that's already really high up on your radar, meaning that it's something that you already pay attention to, those will be the areas that work for you because you're already focused on them. There are a lot of stocks out there in the market, not just the big blue chips that you generally hear about, and you might even find that some hobbies that you have, there are entire industries that exist behind them and have publicly traded stocks that you can invest in. And if you really focus on a couple of those from a day trading standpoint, you can then generate your returns from there. Then you just want to find a good news feed where you can get all of that relevant information. You also should connect with those companies on social media and pay attention to what they're communicating and which channels of communication that they prefer. Now, LinkedIn is actually a great news resource because it's a place where companies actively recruit, so they always want to brag about their latest wins and achievements. Now, that's not a plug for LinkedIn, but there are a lot of resources like that that are out there. We're just recommending that you get the latest and greatest information directly from the source. And keep in mind, you can also follow a number of CEOs and high-level individuals at publicly traded firms, and you can monitor what they're sharing as well. At the end of the day, corporations are people. And I don't mean that from the legal sense. I mean that they are a collective group of people working towards a common goal. So sometimes knowing which ways to trade all comes down to knowing the right people and how they make their decisions. And the last point that I want to make here is about hedging, and we'll get more into that in a moment. But if you're taking on risky investments while day trading, You should also consider offsetting some of that risk by investing similar amounts in less risky investments. Now, don't discount meeting with financial professionals about day trading. They also likely won't recommend it, but they can recommend products for you to help offset that risk.